Good afternoon and welcome back to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Mike Simon with Alpha Mark Advisors, and we're going to focus on why active managers are still relevant in today's market. Thank you very much for joining us at MarketSite today. And how come active management has been muted? Do you think it's part of the popularity attributed to ETFs?
Yes, absolutely. In the market today, there's probably close to 10 trillion in active and passive. Funds have now gained up to about 5 trillion. So there's a huge shift with about probably a trillion of that over the last year and a half. It is certainly a time to be excited, though, to be an active manager. Things had progressed over 2017. For example, the top 10 stocks in the S&P 500 make up 20% of that. And most of the gain in passive management has been in the index funds for the S&P 500.
Right.
So as an active manager, if you're looking at ways to outperform the benchmark, the top 10 names in that index, if they happen to stagger and you don't own them, there's so much opportunity for an active manager to be outside of that boundary.
So with 2018, with the markets being more volatile and seeing movement in those top 10 names, if you were a passive manager, then you'd get average returns or perhaps below average returns if you're just simply following the index.
Right. So if you would say, well, why is active management still relevant? Mm-hmm. Well, passive management, you're guaranteed to get average returns.
Right.
With the active, at least you know what you're looking for. One of the top 2 or 3 things that are relevant for active managers is a higher volatility market, one where there's less correlation, and a little bit higher economic growth. So passive investments tended to outperform active, low volatility, higher correlation, and slow growth. Well, that's what we had in 2017, dominated by the FANG stocks as well, which caused a little bit of serial correlation inside of the passive index. So if you have companies that are doing well and then it's reported and then it's a self-fulfilling prophecy where those same holdings keep growing and become a bigger part of the index.
Right. So then when you see that volatility come back into the market, that's where you have to make your decisions and pick and choose where you want to be. But my question is smart beta, we hear the term smart beta ETFs a lot. Is that the same as active management?
It's definitely not the same. Generally, a smart beta ETF is rule-based, and they're backwards-looking rules that will look at data points historically. Again, it is what I believe caused a lot of the serial correlation in 2017 to create these overweighted, concentrated indexes, so the S&P 500 specifically. So a smart beta will look at rules, so maybe it's the highest growing PE ratios or price performance, whatever the case may be, and then those positions continue to feed on themselves and grow and become a bigger part of the index.
So do you think active management is here to stay, and that 2017 perhaps was an anomaly with the way the market was trading?
Absolutely. I think active is here to stay, and 2018 looks like it's going to be just a great time to be an active manager. We've seen volatility pick up. You've seen the VIX go over 20. Hanging in there around 20, which is a big indicator that we're kind of past when VIX was at 10 last year. Now we're up to 20. You're seeing correlations start to fall apart a little bit. Every time we've had a sell-off, though, we've seen the buy on the dip, which means that the correlations are not gone yet, but they're slowly falling apart. And this will be a great time for active managers. A couple things that I would look for in an active manager. The first one is you don't hear about it as much anymore because active management is kind of taking the back seat, is active share. So a manager that has a high active share, so their percent that is not like the index, has historically outperformed the index. For example, our strategy and our fund, the Alpha Mark Large Cap Growth Fund, has an active share over 95%. We did not own any FANG stocks in 2017, and we still outpaced the S&P 500 by over 700 basis points last year.
All right. Well, thank you very much for joining us at MarketSite today, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.